One of the most important thing in options trading is adjustments, especially when you trade in option selling strategies. Adjustments are like a steering wheel of a car which gives you the required control to navigate from different situations. As a trader, are you able to make good adjustments in your trades? Is there a rule book which you need to follow to do best adjustments? What are the kinds of broad adjustment themes available to you as a trader? Let me show you. Welcome to another video by the Option School. This is your friend Pradeep Singla, and we make content on conservative option trading strategies. For any trade which has gone wrong, obviously we will make adjustments for trade which has gone wrong. There can be multiple adjustments. We categorize them generally into three categories: soft adjustments, which are simple, easy adjustments; slightly hard adjustments, so second category is hard adjustments; and finally pro adjustments. How well you can make these adjustments in your trades differentiate you from mass traders. Let me show you these adjustments through some examples wherein I will take different kinds of adjustments. We take you to Opstra. Now we are on 1st December, and let us say we are trying to make some trades, and first we will see what are the soft adjustments. And on 1st of December at 9:30, let's say a trader is bullish. So what he has done is he has sold some puts. Let's say market is at 26,450. He has gone slightly out of the money and sold 26,000 puts, two lots, thinking that market will go up and he will make easy money, decent returns, 19,000 rupees in two lots only. Now let us see how market behaves. Market has gone down and he's losing 7987, 8,000 rupees already in the trade. Definitely this requires some adjustments to be done. So one of the softest adjustment what he can do, simplest adjustment what he can do is he can scare off this and shift this down. So this is the most basic adjustment, because whatever the trader was thinking has gone wrong and he can close this trade. Adjustment means you're closing the previous trade and you're taking a new trade. So instead of 25,000 now 25,900, you can go little bit down in the trade and maybe he will sell 25,700. So if we see this now, because market has gone down, he wants to change his break even level. So he has shifted his break even level now to 25,652. Earlier it was at a higher level. He can still make some profit in the trade. Let's see how it works. So very simple, straightforward adjustment. You need to surrender little bit of premium and shift your positions down in case of put. And similarly, if that happens on the call side, you need to shift your position up and surrender little bit of premium. Very basic adjustment. Now let's see. Market is further coming down, but he's still far away from his positions. So let's say he keeps on sitting in the trade and it is making down moves, but he's still, let's say what happens to the trade, whether he is required to do any more adjustments or not. And here 950, by the end of the month market again went up and he is not required to do any adjustments. He is making a little bit of profit in the trade, around 6,000 7,000 rupees profit in the trade by the end of the month. So this is a simple adjustment, and then after doing the adjustment his break-even point never got breached, so there was no requirement to do any other adjustments. Let us see now a slightly uh, you can say hard adjustment compared to this with the same month, right? In this case let me reset this and again we'll go to 1st December. So I am not recommending any such adjustment, but yes, it is purely for learning purpose. You can use these concepts in your trades if you are comfortable. So again, now let us say the trader has done a trade wherein he was thinking that market will remain very sideways kind of. So what he has done, he has sold this okay 26,000 put, and simultaneously he has sold one, let's say 27,000 call, right? Thinking that okay, I'm making a very wide range trade, it's a short strangle, and there's a lot of space in the market, and I just with one lot I can make decent amount of money in the trade. Let's see how market behaves and what kind of adjustments this person can do. Yes, I have already shown you one soft adjustment. This one will be not so soft. This needs to be a slightly hard adjustment, because from short strangle, uh, if we convert the trade into something else, that will not be a simple adjustment, but easy to understand. Let us see. So first day nothing happened. Second day market went down. Third day, okay, still bearable, not much of a issue. So it's giving. But now if you see on 9th, what has happened? Market has already gone below the break even point, the lower break even point. So one of the ways is, okay, I shift this put down and then see what happens. That is the soft part of the adjustment. Now the hard adjustment is that I will just scare off this call at 20 rupees. My put is 26,000 and market is already 25,800. So I will go to option chain and convert this trade into a short straddle. So I will sell 26,000 call also. So instead of shifting my put, I say, okay, let me be more aggressive. I took some more premium from the market. Now my profit can be 31,000 rupees and I have created a short straddle, and now I am ready to see what happens. And in case now my break even breaks on any side, I can do something different. Let's see now how it worked. It's not necessary that, okay, whatever adjustment you do, it will result into more profits only. At times you have to go with the market, you have to flow with the market. In this case, when market is going down, so what the trader has done, he has brought his sold call down, so that whatever loss he is making in his sold put, he can more or less compensate through call. If he kept his original call, it was only 20 rupees and it can give him protection for only 20 rupees. It cannot go negative. So what he did, he added a decent premium in the call, so that if market further goes down, he can have better protection than 20 rupees. Next day, if you see, okay, market has again gone down. If you see here, he sold at 214 rupees that call, which is now 182, whereas this previous call, which he exited in 20 rupees only for. So this call has given only 6 rupees, whereas this call has given him 2300, 2400 rupees. So that is the benefit of adjustment. Otherwise, he would have been in a loss of around 6,000 rupees, right? Next day, if you see, okay, now market has gone back, and his loss has also reduced, so nothing to be done. No break-even points are getting touched. Now this trade is into profit. Again, a very decent profit as of now. Again, no break-even points are touched, and trade is into a very solid profit of, you can say, 7,900 rupees. Shifting here and there. Now this is a slightly, you can say, this was a slightly hard adjustment. Let's say we keep it for another day. We keep it till expiry. This trade is giving 16, 70,000 rupees, right? So this was a slightly hard adjustment, that, okay, you scared of a low premium call and then you shift it, and now that call may not be giving you very good results because market is now gone up, but still the put which you have sold, which was giving you a loss, has now recovered, right? Now let us see, can there be a harder adjustment than this? So this will qualify into an expert adjustment. Now, if you see, as of now, on 26th December, this trade is giving you 17,000 rupees. Obviously, it makes sense to book this profit. But then sometimes you just leave this profit and market makes a wild swing here and there. Near to expiry, obviously the gamma rays also increase. So if I see the PNL, okay, as an expert trader, what I will see, okay, call is still having 156 rupees, but this put is having only 28 rupees. Let me book this put. So what I will do, I'll book this put in 28 rupees, book my profit, right? And now I do not want to take this unlimited risk of market again making a big move and creating loss for me. So what can be the adjustment? Again, you go to option chain. You have a 26,000 calls sold, which is okay. What is the break even point now? Break even point is around 26,387. I want more profit to be captured, but I do not want to take more risk. So what I will do, I will buy this 26,300 call. So what here, as a pro trader, what has been done that okay, put where profit was already there, that is booked. Call where still lot of profit is possible is kept just like that, but we have protected that call from any further loss, because in case market goes to 26,300, I don't want to lose. Now you see, now this diagram is all green. As of now I'm making 17,000 rupees, and even if market goes here, it's not that okay I will be in loss, I will be still making some money, like 5,250 it is showing. So it is not that okay I will be making more money only by this, by doing this adjustment, but only thing is that okay, I do not want to leave my chance of making 27,000 rupees. I am very happy with this profit. We are discussing these things to show various possibilities, right? So let us see what happens now. Next day, okay, market has gone down. I'm making 20,000 rupees. Next day, this is the expiry day, so you're making 27,000 rupees. Definitely, it makes sense to close the trade now. So this was a little bit of expert thing that okay, what you have done is you have scared off that put. See that put. Now that put would have become 122 rupees. Earlier it was only 28 rupees. So 132 minus 28, the thing which is already given me 78 rupees and it can give me only 28 rupees. Why should I keep it? And when we are staring at the fag end of the expiry, and gamma risk is very high, right? Hope it makes some sense that okay, there can be different adjustments. First is very simple adjustment, shift the trade. Another adjustment can be you shift the trade and shift it to next expiry. Also do not lose the premium. Obviously the decay will become slower. Second is that okay, you change the strategy from strangle, you can convert it into straddle. Fourth is okay, you can change the strategy strangle to straddle, and then later on you can convert it into a bear call spread also. There are adjustments which are very expert adjustments, like you are shifting your strategy, like in iron condor you are adding a calendar spread, or you are adding a bear call spread, or you are adding a bull call spread in your other trades. So when you are combining different strategies, you need to know when to combine, till what time you need to keep that new trade. It should not happen that okay, old trade is giving you a loss and you have added a new trade which as of now is giving a profit, but then if market makes wilder move, the new trade also gives loss, so overall loss gets increased. So it should not happen. So you need to know that okay, if I'm doing an adjustment strategy, it has a limited use. It is useful only up to a particular time or particular level of the market. Based on that, you need to remove that and maybe then introduce a new adjustment, right? So we are conducting a workshop on 29th March, wherein we will be talking about 4 to 5 different kinds of adjustments. Some will be soft adjustments, some will be hard adjustments, some will be expert adjustments to navigate through the whole year. We will be showing 12 months of back testing also. So this is purely on iron condor. Why iron condor? Because iron condor in itself is a uh, limited loss, limited profit. It's a hedge strategy. So it will never do something like this, that okay, the account is blown out just because of some big move in the market. So it is self hedged, and then it becomes much easier to handle those strategies. Please feel free to write any questions, observations, or suggestions in the comment section. Do hit like button and subscribe button. See you in our next video. All the best. Bye.